and his real focus is on silver. And he basically thinks that silver is going to rip the lid off of the market, as he goes on to say it is revising sharply upward in their mind, and that the technicals of both price and long-term momentum, he believes, are telling the market what is already occurring and what's about to occur. A repricing, he says, of silver's reality, whatever that means. So I've never heard him so bullish on silver. He was saying that if it follows the previous cycles of 2010 and 11 or 1979 and 80, you can get as high as $100 or $200 on this move. But it's interesting, if you take the 45-year cup and handle of silver, which is now literally almost a double cup and handle, and 45 years, one of the most powerful technical moves, period, in technical analysis, the way that you would figure out where the next stop is and or where the target would be, and even if this analyst who was looking at it didn't know what it was, is you take the top of the cup in 1980, goes down to the bottom in the 90s to $4, goes back up to 50 in 2011, comes down and is making that final push. When it gets through that 50 level, you take the distance from top to bottom, which would be 50 to 4, that's 46, add it to the top, 50 plus 46, your next target's $96. That's what Michael is saying right here. 100 plus, he thinks, if compared to 2010 and 11, that's where we'd end up.
That'd be phenomenal. But do you think we're going to bounce off the $50 for a bit here, or are we going to just break right through it?
You know, the markets, for as far back as I can remember, find these big numbers, like gold at 2,000, and it would just keep hitting it and hitting it and hitting it. And when it goes through, it's gone. It just depends how many times does it take to challenge it. And I would argue that, 50 is just psychological. If you go back and look at 1980 and 2011, it was a cup of coffee long that it hit 50 for both times. And so what kind of resistance really is there other than, mostly psychological? And, Kai, who the hell knows what real price discovery is in gold and silver? It's not even debatable that the central banks of the West have held down gold and silver for a long time. When real price discovery happens, because I believe that you can only manipulate a market for so long by pushing it in the direction that it is going. And it was easy for the West to do this for a long time. But you have a whole bunch of players around the globe that are coordinated, motivated, sophisticated, wealthy. They know what we're doing by holding down the paper price. They're standing for delivery, largely in London, in order to beat us at our own game. And now the folks in the West here get it. The big traders, either they were tapped on the shoulder and said, start bringing this shit back, pardon my French, and you can call it tariffs all you want to fool the public. It's not tariffs, it's about reshoring. Get it back. And that's what they're doing. Truly, that is what they're doing. And that's why I just think that it's easy for people like you and I and the people listening to this show, Kai, to get wrapped up in recency bias. We've been beaten up so badly over so many years in an environment that was counterintuitive to logic and our belief structure. But our belief structure and logic and mathematics have a way of playing out over time. You can't hide from math. And a lot of this is just simply math and logic, and it's finally playing out. I think the sky's the limit. So will it bounce through 50? Eventually. Will it do it first time? Maybe. Maybe not. It's irrelevant. I think ultimately sky's the limit once it does get through, though.
Yeah, it's like we often talk about the big picture. I want to get a tad more granular with you, just in terms of like U.S. economic data that's being presented to us. We just got ADP jobs report as well, plus the U.S. government shutdown on top of it. How significant is that for the markets and for what we're talking about here, gold and silver? What does it really mean? Does it trigger more safe haven demand?
Well, it should. I mean, I see by the CPI numbers and the Bureau of, we should just call it the BS instead of the BLS, and their massaging of employment numbers is that, I mean, you take two things away. Number one, inflation is far higher than we are being told. Just ask John Williams of shadowstats.com. He'll say at 8 to the 3% that we're talking about, that's 11%. And the unemployment numbers are far worse than we have been told. And it's interesting, they keep issuing these numbers. The market reacts, what a great economy we have. And then they quietly revise it down to the largest revisions ever. And, month over month, they're taking away, hundreds of thousands of jobs that we thought were created. No, not really. Our model was wrong. Sorry. But the market's already reacted. I think that it's becoming obvious that we're heading towards stagflation, which is a slowing economy based connected to higher prices and inflation. And it's really the most painful part or most painful outcome. Higher prices, lesser and lesser growth. And I think it's a frightening realization that the job market truly is cooling down. And so now the Fed has to decide, what do we do? Do we lower rates? And if we continue to lower rates, what does that signal to the rest of the world? That we've given up on any hope of austerity. We just tighten a little bit and the whole dang thing blows apart. So are you going to sacrifice the employment market and then reignite the inflation engine when we haven't even hit our target for 53 straight months? And the number that we tell the public is a lie anyway. So what do you do? And this is the quandary that the Federal Reserve is in. And that's why I think you'll see what we see in Canada and in London. And that is a series of short, the front end of the market, driven down through rate cuts. But the back end, no. We're going to go the other direction because we're not going to hold any duration treasuries of yours without a much higher rate. In other words, can the Federal Reserve, through yield curve control the back end? Sure, they probably could, which again is something that should frighten everybody. But if not, the market is going to demand much higher rates for the risk of holding our debt, which continues unabated. Our fiscal irresponsibility is just an absolute embarrassment. And creating still nearly $1 trillion every 100 plus days, that's not going to work for the rest of the world. And you get to a point where if Trump is able to lower rates on the front end low enough, you're going to get the very big money that is acquiesced to putting it into short-term treasuries, where now the rate that they are trying to get to of 2% on the federal funds rate is less than the CPI number of almost 3%. They will not stand for that. And there's your 1% running to gold. And we're already there from a real standpoint with inflation. The dollar's down 11% this year. So a 4% short-term treasury halfway through the year or 3/4 of the way through the year is giving you back 3%. The dollar's down 11. You're negative 8% real return. Gold and silver are both at or above 50% return for the year. This is the trend that we're seeing globally, where the biggest money is always 3 steps ahead of the crowd. They've been shorting or selling, pairing off their treasuries and buying commodities. This whole run up, when everyone else, you speak of vindication, when everyone else said we were stupid, I said, no, we're not stupid. Look what the most well-informed traders in the world are doing quietly before the rest of you idiots catch on. And I don't mean idiots. I just mean the people in the mainstream who laugh at people like us who see things differently, instead of having an open mind and say things are changing and we cannot go around the world doing what we do and have massive fiscal irresponsibility without there being consequences. And you are beginning to see those consequences in the lack of demand for the U.S. Treasury. So I got a good idea. Let's come up with something called the Genius Act. And we can use that to fund the front end of the Treasury market with synthetic demand through stablecoin creation. I mean, we're getting to that last end stage game where things are going to start to get real interesting, and I think really fast also.
Absolutely. No, Andy, it's a perfect segue actually to my final question for you today is, like, what should new investors in this space do? We're seeing a lot of new subscribers here on this channel. We're seeing a lot new money flowing into this space. What's the best advice you have for them right now?
The best advice would be to not save in dollars, period. Assets are what will save you in this environment. And you can see that in just about everything. Now, real estate might be the one asset that I would not speculate on, certainly. But I do think assets are the place to be. Now, of course, my focus would be on gold and silver, the real value, and platinum. The real value is probably in platinum and silver, although the premiums on the pre-1933 gold coins are the lowest I've seen in my career. There is great value. The real value is in silver. The word is asymmetrical. Low downside, massive upside. The LBMA is almost out of all of their free float of silver, which can just like that trigger contagion and a massive spike on in price. Billions of ounces are coming, or dollars worth of silver are coming into the COMEX every single week, and the U.S. government just reclassified it a critical mineral. Food for thought, but it doesn't have to just be in my universe. I'm sure there are a lot of people out there who would want to look at cryptocurrencies as a way to shelter from a devaluing dollar. The bottom line simply is this, is that if you are saving dollars, you have a very high probability of going broke in terms of your purchasing power. We've seen that already with 11% decline, but look at what Stephen Miran, the architect of the Mar-a-Lago Accord, who is now on the Federal Reserve and is still an advisor to Trump, his whole idea is to devalue the dollar in order to reshore gold. What did Vice President Vance say? To reshore manufacturing, excuse me. What did Vice President Vance say? Triffin's dilemma, being the world reserve currency, is no longer a good deal for us. It is a subsidy on the consumer and a drag against manufacturing. It's really not a good deal for us. What does Trump say about a strong dollar? Sure, it's great, but you sure don't do a lot of business or have a lot of tourism. They're telling you they want to devalue the dollar. It's the only way to pay off the debt. It's the only way to have any hope of manufacturing success. It is the only path left to take. Now, there's other stuff to that next time when we get more time, we'll talk about it. But a devalued dollar is in the cards, and so do the best you can to accumulate assets, whatever that means to you. Stay away from holding your wealth in dollars. It's a sucker's game right now. You can be right based upon economics and logic and be wrong for a long time, because people that have been using suppression to hold down these markets, these are very powerful folks who have now gone the other way, and they're like, no. I think we're going to go long and stand for delivery. There are different things happening, different dynamics, I believe, that will make you look right in spades before it's all said and done.